Welcome to the UK Mortgage Market Insights for the week ending Friday, the 17th of July. Now, there's a bit to get through this week. We've got swap rates on the move, a run of lenders putting rates up rather than down, a couple of genuinely useful criteria changes, some GDP data that's landed, and a bit of politics that's got more teeth for your mortgage than you might think. So stick around to the end though, because I'll tell you exactly who benefits most out of everything we're covering. And look, if you're anything like me, you're still nursing your wounds a bit from Wednesday night. England out of the World Cup at the semi-final stage again, so no final for us, though there's still the third place match against France on Saturday to keep the bunting up a little bit longer. Anyway, back to the day job. If you're new here, please do hit subscribe. It genuinely helps the channel to grow more than you'd think. But for now, let's get straight into the news. So swap rates first, because these are the ones that really tell you where mortgage pricing's heading before the lenders even move. And this week, they've all crept up. 2-year swaps are sat at 4.179, up from 4 last week, and the 5-year's gone up a touch more, now at 4.260 from 4.179. And it's not just the short end either. Right the way out along the curve, 1-year, 3-year, 7-year, 10-year, they've all nudged up. Now I've put the latest chart on the screen, so if you look at where we've come from, and I've had a proper look at the 18-month chart this week, swaps were sat around 4% back in spring last year. They then dropped away to about 3.5, 3.6 through the back half of 2025 and early into this year. And then pretty much since the trouble in the Middle East, they've shot up into the mid 4% range back in the spring. And they've been drifting higher ever since. So compared to a year ago, we're a good 0.5% higher on swaps, which is no small thing when you're talking mortgage pricing. And I had a look at the forward curve too. And again, you can see that on screen. This is basically the market's best guess at where rates are heading over the next 10, 15 years. It doesn't price in much in the way of Bank of England base rate cuts anytime soon. It's fairly flat to around 2032, then it starts climbing steadily towards about 5% by the mid-2030s. Now, that far out, take it with a pinch of salt. Long-term curves shift about constantly, but the short version is, the market isn't betting on cheap money coming back in a hurry, and money markets are currently pricing in 1, if not 2, base rate increases. So given swap rates have risen, it's no great surprise to hear that a fair few lenders have followed, and this is a proper reversal from the last few weeks where everyone's been cutting. April Mortgage, Principality on product transfers, and Bank of Ireland have all put rates up. Gen H are up by as much as 0.19%. Coventry have increased right across their fixed rate range, and then the bigger names, Barclays up by 0.37, Nationwide up to 0.35, and Virgin are also up to 0.35. So that's 8 lenders in 1 week moving the wrong way for borrowers, and when swaps rise like they have, that's exactly what tends to follow. We have warned that this can happen, and that's why we say secure a rate quickly. Don't sit on your hands. Now, on the economic side, we had some GDP figures out from the ONS yesterday. Monthly GDP grew by 0.1% in May, following a fall of 0.1% in April, and growth of 0.3% in March. So it's a bit stop-start if I'm honest. Not exactly a picture of strong momentum. The growth in May came from services up 0.3, though that was partly offset by production falling 0.5 and construction down 0.8. Patchy figures like this are exactly the sort of thing that keeps the Bank of England cautious, and it also feeds into why swap rates have been jumpy as well. Now, it's not all one-way traffic, because while pricing's gone up, a couple of lenders have actually loosened things up on criteria this week, which is worth knowing if you're finding it tough to get on the ladder or move up it. Leeds Building Society have launched a new 2% deposit mortgage for first-time buyers. That's a deposit of as little as £5,000, lending up to 5 times income, a maximum loan of £500,000, minimum income of £30,000. It's a 5-year fixed, and is available to both employed and self-employed applicants. And gifted deposits are accepted too. That's a really positive step for anyone really struggling to save a deposit. Nationwide have also made changes that'll help joint borrowers specifically. They've dropped the qualifying income for the 6 times income lending from £100,000 down to £75,000 for both home movers and remortgage customers. So couples on a lower combined income can now access that higher borrowing multiple which for a lot of people moving up the ladder opens some doors that weren't open a fortnight ago. Now here's the one that I think you should really keep an eye on though, because it's closer to home than people realise. We all know the Middle East ceasefire breaking down has been rattling markets, but there's something happening right here in Westminster that I reckon is having just as much of an effect on swap rates. Andy Burnham becomes Prime Minister next week, and the big question is who he picks as Chancellor. Ed Miliband was the early favourite, being a close ally, but the strongest steer over the last few days is that it's actually going to be Shabana Mahmood, who's been talked about as a bit of a fiscal hawk with very little economic experience. Nothing's officially confirmed yet, so this one's still very much one to watch. But the direction of travel matters, because we've seen before what happens when the market gets spooked by a new Chancellor and a new budget. Anyone remember Liz Truss? So genuinely, keep half an eye on this one over the next couple of weeks because it could end up moving rates more than anything else we've talked about today. But here's the thing, if your current fixed rate is ending in the next few months, let me know in the comments because I'd genuinely be interested to hear how people are feeling about locking in with everything that's going on in the markets right now. Anyway, so pulling all of this together, rates have gone up this week, no getting around that, swaps rose and lenders followed. But here's the thing I really want you to take away from this. We are properly busy at the moment, genuinely one of our busiest periods, and the reason is simple. This is still very much a buyer's market. People are getting real bargains on the property itself, and often that saving more than makes up for a slightly higher rate. So if you've been sat on your hands waiting for the perfect moment, my advice is don't. The property savings on offer right now can easily outweigh the rate difference. So who benefits most this week? Well look, I'd say there are two groups of people. First time buyers with a smaller deposit, because that leads product genuinely opens doors. And let's not forget all the other options available too, where lenders are really looking to help people get onto the property ladder. The other group is couples moving or remortgaging who got knocked back before on affordability. Because with changes like those from Nationwide that we've seen this week, they could be the difference between the house you wanted and the house you settled for. Anyway, that's it from me this week. If you really found this useful, please do subscribe. It really does help the channel. And drop any questions or thoughts in the comments below. I do read every one, and I try to make this channel as interactive as possible. I'm Craig, this has been the UK Mortgage Market Insights, and I'll see you next Friday. Take care.